oil and natural gas outlook. I have a great panel here, and let me start by introducing the folks in like in the order that they're listed in the program. For myself, I'm a 35-year veteran of Silicon Valley, and right now I think it's kind of like a little bit derogatory, so I'm gonna not say much about me because all of the Silicon Valley recent issues and tribulations, I'll just be conducting the panel. But anyways, let's start from the introduction of Timothy Smith, which comes from a single family office of Petro Lucrum Incorporated, and then we'll go to Jay.
Sounds good, Arthur. Thanks a lot. And Marty, thanks for having me back. It's been great to participate with your events over the years throughout a number of different cities, and I've always found it to be very insightful and great networking. So I'm glad to join virtually today, although I wish I was in Austin tonight, but I'll have to catch the next one. As Arthur pointed out, I'm with a family office here in Houston, Texas. We're a single family G4 concentrated on generational wealth transfer, focused largely on direct investments and co-investments with a growing allocation into alternative investments. So our wealth creation history has been in the energy industry, although we do cover all asset classes and many sectors at this point of the game, including a number of alternative energy and energy transition opportunities. So looking forward to the general conversation with everyone today.
Great. Jay?
Yeah, Jay Young. I'm a fourth generation oil and gas guy. I've been around the business all my life, but also go back a few generations. My great grandfather drilled wells out in Big Spring, Pennsylvania to Big Spring to finished up in Coahoma, outside Big Spring. He drilled and supervised the oil field on the south side of I-20 at one time. So King Operating I wrote a book called The Upside of Oil and Gas Investing. If I can see, here it is. Wrote The Upside of Oil and Gas Investing because the way we do it is different, because we're buying assets and value adding. We're looking like right now 20,000 acres. We participated in 20,000 acres. We're going to put $100 million to work this year drilling wells and increasing the value of that field. Look to divest it. So we're one of the only ones that do retail investors to family offices to look at oil and gas fields that we can lease the properties. We have Wyoming. We have 50,000 acres in Wyoming, multi-pay, whatever. Same as East Texas. We've got a lot of acreage out in East Texas, and we have some also in West Texas, Permian. So we're all excited about that and what we're doing there. So operator since 1996 and been in the business for a long time. So,
well, thanks, Jay. Next, I'd like to introduce Steve Blackwell, CEO of the Retain and Grow Wealth. Not you're there, right? Physically, okay. Your microphone is not working.
That working? All right.
Yeah,
thanks, Arthur. Anyways, Marty, thanks for the invitation back. The company's Invito Energy Partners. I'm the CEO and co-founder. My background's been about 15 years in the energy space. Most of that experience was primarily as president of a company called Petromax Operating, where we developed about 4 different assets and exited out of those for a little over $1 billion. Started Invito Energy Partners a couple of years ago, and essentially what we are is an investment fund, a drilling fund. We raise capital primarily through relationships with investment advisors and accredited investors, and it's primarily a tax play initially. So we're going out and it's a drilling fund, so we're drilling new wells. Most of the investors are looking initially at a tax play strategy to reduce their taxes, and then obviously develop passive income. So the fund's agnostic. We can operate assets or we can do non-operated assets. It's just based upon the returns. So that's who Invito is, and that's my background.
Now it's David Lewis, the Chief Executive Officer of Energy Capital Vietnam.
Thanks, Arthur, and thank you, Marty, for having me here today. Despite the name of the company, my roots are here in Texas, in the upstream industry. Actually, my family had, we still have some mineral rights out in West Texas and East Texas, and come from the family the farming and ranching community. And a lot of oil wells were drilled out, and my grandfather's ranch back in the 40s has discovered some fields out there. So I come from this space with a deep understanding over the commodity. I got in the industry after in a prior life, I was in the Marine Corps, did a couple of deployments overseas, got out, went worked on Capitol Hill for KVH, covering military and national security issues. Before ultimately come back to Texas, getting the oil and gas business, we started a company back in 08, 09. I recognized Timothy. We ran into each other a few times at NAPE. And then as the landscape changed in terms of shale revolution and our position as a country in terms of the ability to export, I found a lot of opportunity in Vietnam as demand side in terms of future growth market for big consumption. So created the company in 2015 with the vision of focus on securing the licenses and rights from the government to develop, build, and own critical infrastructure choke points for developing the LNG market in Vietnam. It's all based off of their power demand. They need to basically double their power generation capacity over the next 10 years. So a lot of upside. And overall, just controlling critical infrastructure and energy infrastructure in a growing market. We had a kind of a simplistic business model. Rising tide lifts all boats. Vietnam's GDP is up and to the right and projected to maintain that way in the next couple of decades. So we're excited about long-term opportunities. Thank you.
Well, thank you. The current political geo situation is kind of very complex, and then I think that's what basically affects everybody here on this panel in terms of where the prices are going to go. And nobody, not even you guys, have a crystal ball where the prices are going to go, or what the outcome of certain geopolitical issues are going to be going to. But in any event, I still would like to talk a little bit at the beginning of the panel about where the prices might be going to. Like, what do you see, Jay? I'll start with Jay. Prices going of the oil prices in like next 2 to 3 years?
It's a good question, and I feel like there's probably 3 reasons why we're not drilling like we should be or like we were before the pandemic. 3 big reasons. Number one, the government. I mean, the government's shutting us down in a sense of not allowing us to drill as much as freely as we'd like to. And what I mean by that is we like to deploy capital in Wyoming and Colorado on assets we have there, and they're pushing us back a month, 2 months, 3 months. And in Texas the other day, we had to change up a permit, and it took us 1 day. I mean, Texas, Oklahoma, Kansas, all day long, in other parts of the country, it's just hard. Also, capital. The financial markets are frozen. I mean, they're not necessarily opened up like they were before the pandemic. They probably got stung with some of that minus $30, $40 oil. So they're like, okay, we're going to stay on the sidelines. And with a lot of their people that are green, and I don't mean necessarily green people like the color green, but green people, tree huggers and things that don't want to drill, and they're keeping, and this is also the third reason, is public companies aren't drilling. And I believe a lot of that is because there are a lot of people on their boards that are saying, hey, you know what? We don't want to drill for oil and gas. We want you to pay back dividends to shareholders, pay down debt, or buy back shares. So we're not drilling. So I feel like that the peak demand, we're still out from peak demand 3, 5, 10 years to where we're still at demand and our supply isn't going to be there. So I do feel like that prices will go up this summer, at the end of this year. I believe if they're not going to go up a lot, at least they're going to stay here at this $65 to $75 bottom, and everything up here is going to be, will go up. And I feel like that the prices will stay strong, Arthur, for a long period of time.
All right. Well, we'll see how that all plays out, right? We have, I mean, you guys also have a big push from you, because I don't drill the gas, so I'm actually using electrical cars because, you know, that's where I belong to. So that's my second question is here coming up, and I'm going to try to ask the question to Timothy. Timothy, you know, a lot of the electrical new hype of going and converting into the green technology, right? It still utilizes predominantly oil and other gas related products. So how do you see that whole thing, meaning all that transition going on right now to electric cars?
Yeah, great question. So, you know, I kind of share the same perspective that Elon Musk has in prior conversations. You know, this is an all energy equation. So we're happy to drill wells and also happy to invest in electric vehicle infrastructure. Ultimately for us, we're less philosophical in our approach and more bottom line. But at the end of the day, when you look at the global macro environment, you know, we do need to diversify our energy sources. We also need to continue to push new sources of energy that'll make things happen. Obviously, with some of the innovation and necessity in general, there definitely has been a lot of innovation to improve a lot of things from renewable energies to electric vehicle. And that primarily has been pushed with battery advancements and things of that nature. So our approach, you know, would be to look at individual service businesses or infrastructure owners in that space. We're also quite interested in lithium and cobalt mining opportunities and things of that nature that we think are ahead of the opportunity in that space. You know, that said, you know, back to some of Jay's comments, you know, domestically, you know, our best bet is to continue to, you know, push our resources as aggressively as we can in an economical and a regulatory and environmental positive approach. And in theory, every good fossil fuel or oil and gas petro company should be using a certain level of ESG principles in their processes. Yes, somebody could argue carbon footprint and so on, but you know, EVs, I don't have the exact numbers, but when you get into overall consumption of power, obviously it's circumstantial based on region and available infrastructure, but they're still using a lot of coal, natural gas powered energy to fund or fuel a lot of that electricity, right? And all of this points out to it doesn't really have to be competitive in our mind as much as a lab expanding, and as technology and innovation makes those changes, then yeah, sure, maybe we'll be less dependent on energy. But the big thing that I think Jay and David and my other panelists have always talked about or even laughed about is people don't look past the fact that oil is consumed by every industry on a plethora of products. Transportation and fuel is really just one of the components. Arthur, back to you.
I agree. I mean, when you charge the car and then you wonder about the kilowatts of each one of those charges, right? I mean, depending on where you're charging that car, it's going to be somehow produced from somewhere. So yeah, I think that there's a parallel coexistence path, just like it was between, let's say, a radio and television that was invented like many years ago, but each one of them is going to take the best part of their market space. I want to ask something to Steve, because Steve, one of the things that we know is happening right now is the war in Ukraine, right? And then that's a huge political issue with OPEC and with the supply of the energy as May. And how do you see this whole world playing out right now? I mean, with Russia being disconnected from the main markets to a degree, but still doing some kind of like backdoor deals, is there going to be enough energy for us to kind of feel comfortable?
Well, that's a great question. I don't know that I necessarily have the answer to that. What's going to happen over with Russia and Ukraine? I think if you look at the second half of last year, when we had prices drop substantially from the highs and above 120 in June, you know, part of that was obviously the Fed increasing rates, and some of the uncertainty from the economy, but also a lot of what people thought was going to happen with Russia supply wasn't happening at the moment. So it was still finding a home, specifically with China, India, and some other places. So I think with the recent price caps that have been put in place, Russia's come out and said they're going to decrease their supply by about 500,000 barrels. If you look at the IEA projections for 2023 in terms of what they're projecting for demand growth and what they're projecting for supply growth, it kind of balances out at the moment with that 500,000 barrel decrease from Russia. But we'll see how that plays out with the remainder of the year. I think obviously how China unfolds in terms of, they're projecting 4 to 5% GDP this year, but they're just coming off the, starting to finally open back up. But I think I don't know the answer to that, especially on the gas side. I think the United States was a big bailout for Europe through the last 2022. If we weren't able to export the LNG that we were, and if they wouldn't have had a mild winter, it would have been pretty painful over in Europe. So it'll be interesting to see how this plays out. I'm not sure what the end game is from the administration standpoint here, but from an energy supply standpoint, the global market is fracturing somewhat. We just had, I don't know if you saw, but we just had, China broker a deal with Saudi Arabia and Iran today. That was announced over the weekend. So that's a little bit of a poke in the eye at America. How that's going to unfold, I'm not really sure as well. Are the Iran barrels going to come back on the market? Most people believe they're still in the market, but they're just not on the market. So we'll see. I don't have a crystal ball to that, but I think looking at 23, it's really going to be, does the Russian supply decrease by 500,000 barrels like they say it's going to? And we'll see how that plays out.
Well, I can hear.
Yeah.
Yeah, if you can repeat that question, because I don't hear it.
Yeah. I think Marty's comment was that India's, importing like 30% of their oil from Russia right now, and he was referencing back in the 70s where the global market was kind of fragmented, which was kind of my comment. So I'm not really sure. I mean, honestly, that plays into the global economy. I'm not really sure what's going to happen after this whole Russia-Ukraine war with the global economy, with the global energy markets. I don't know how it's going to play out, but at the end of the day, here's what I do know: everybody needs oil. Everybody needs natural gas. The renewables are not even in the stratosphere of replacing those. So they're going to do what they need to get them. It's that simple. So we'll see how it plays out.
Yeah, I would just say global demand for oil and gas has not decreased. It still increases on an annual basis. So we actually, taking politics aside entirely, whatever production is available from Russia to go basically to the Indians at a discount is good for markets, because as we all know, there's a deficit right now in the upstream space from all the bigs, majors, all the offshore projects that haven't been getting developed, the slowdown in domestic drilling here in the U.S. So we're not keeping up with demand year over year increasing on the oil side. On natural gas, there's a ton of supply, as we know. The spikes last year in prices were a temporary dislocation between Russian gas coming off the market within Europe, a big buyer, and the U.S. not being able to ramp up as quickly as we wanted because it takes time to build infrastructure. But that's happening now. Where the U.S. is the largest exporter of LNG, we're increasing our capacity. It'll be online by 25, 26. The Qataris are self-funding an expansion of the North Sea field. So they're, I think, adding 50 million tons of capacity. So there's not a lack of resources, natural gas and LNG, and the market will, it's already correcting itself in terms of pricing is coming down. You see that domestically here with natural gas. But on the oil, I'm in the natural gas business, LNG. In a prior life, I was in oil. oil, unfortunately, I see it just continuing to go up because of demand increasing, and regardless, and we're not keeping up from our drilling activities to keep up with future growth.
Yeah, and I want to ask you, David, because we talked earlier, and then I see that you have some kind of a major operation right now going into the Vietnam on the LG side. Can you tell us more about it? What exactly it is that you're doing?
Sure. So we're developing an LNG power project in Vietnam, and the problem we're solving in Hanoi is electricity deficit. And we're doing that through LNG power. LNG will source from the U.S. And we have Gunvor as our trading partner and other strategic partners for the project. BGRIM Power based in Thailand, Siemens Energy. So we have a JDA in place with BGRIM, and we'll execute a JDA with Siemens once some formal approvals are issued from the government in the next 6 to 9 months or so. But either way, its bottom line is it's 1.8 gigawatts of power generation. So they want about $1.8 billion to build. Part of the reason why I love the infrastructure space, leverage. So coming from the upstream, there's no room for leverage to drill a well, and you can never get rid of all the risks we know of in the upstream space. But I like an infrastructure. The development time period is risk period. Once you reach financial close, we already have Deutsche Bank mandated, for providing the debt there. So for $1.2 billion of debt coming over, we have about $550 million of equity. Half is committed from our partners. Raise the remainder after we have the PPA, power purchase agreement, negotiated with the government, and that'll be a long-term offtake contract. We're going to be selling electricity to the government of Vietnam for the next 25 years. So we're excited about that, what it means, but overall, we're excited about the opportunity to build out a market for U.S. natural gas, via LNG import terminals to Vietnam. Yes, Marty. So all we do is build critical infrastructure to meet the needs within Vietnam. So our whole business model is based off of satisfying the growing market within Vietnam. Yeah, Vietnam only. Yep.
Great.
It's regas infrastructure for context. So we're demand side for exports out of the U.S.
Great. Well, fantastic. That sounds really interesting. I was actually involved with a little project that the guys were converting the regular 747 engines, jets that were retired on the desert, and then converted into the turbines, and powering generating the electricity using the LG. So that was like a cheap way of bypassing the Siemens and all the other guys, but it's not here or there. I wanted to talk, go back to the family kind of operations to our guy Jay, and then I wanted to ask, Jay, in your knowledge of the family offices, what are the best deals and opportunities for family offices in the oil industry?
Yeah, I think it's a great question, because at the end of the day, I mean, it's all about capital and making money, and how do you do this? And like our project that we're beginning in the Permian today, you got to put yourself alongside or partner with, people that have your thought in mind, or your best interest in mind, and what our project is. And one of our panelists mentioned, tax benefits. I mean, there's great benefits in oil and gas, no question. Don't do it for that, but hey, you know what? It is something that really does help. But like we'll put $125 million to work in equity this year, only in drilling, 15 wells and acreage and lease bonuses and drilling wells this year. Put yourself alongside that and say, hey, I'll come in like, if you have Timothy Smith type money, come in with $25 million or something, and you could be a 20% or partner with us or something. Or if you're a retail investor, we have openings for retail investors, the normal $200,000 to $500,000, $1 million type of offices as well. Come in with us, and then drill some wells with us this year, and in lieu of, because you got to have a number of locations. There's a lot of deals out there that don't have the scalability, if you will, of looking for, like our project today has 200 to 300 different locations. We just have to prove them up for an oil and gas company, Because if the oil and gas business is great, it has benefits, it has monthly income, but the big thing is scalability. Can you scale it enough every year to have a liquidity event? Our project with 125 million could be worth $200 to $300 million by end of this year. With equity, we either look to sell it at that time, or we'll get some debt next year to increase the value, drill more wells, and so forth. So I just think that there's a great opportunity out there still in regards to drilling good wells in good areas, but you need to be with the right partner, number one. Number two is look for somebody that is looking at, has good assets that you can go in and place capital to work, having multiple different locations. I saw a bunch of deals for sale this year that they have they drilled 30 wells, but they have 10 more wells they can drill. You need to have a lot more than that. You need to have at least twice as many, future locations that they've proved up before you can sell. So it's very important to have that. I mean, the monthly income is always great, but there's a lot of people that can do that in other industries that don't have the risk that oil and gas does. We like the projects, and the way we restructured our business at King Operating is to look at, hey, we're going to look at this every year to have a divestiture to increase the value of assets by drilling, number one, and then selling it and having the opportunity to sell it every year. So I think that's important.
Well, thanks. Well, Timothy, you have probably the most experience with the family offices, right? I mean, you've been doing this for forever. So tell me, what kind of opportunities you're looking for? What are you going to be doing this year that excites you the most?
Yeah, so I mean, look, for us, we don't always invest in trends or anything to that nature. Really, we're looking at unique opportunities in areas that we understand or that our partners understand. So Jay brings up a great point that, particularly in oil and gas, and this is certainly a message for any of my peers out there, having the right partner is absolutely critical. And the right team's got to really know what they're getting into. It's has a lot to do with geology, has a lot to do with engineering. In terms of where to find those types of opportunities on the oil and gas side, look, there's oil field service opportunities, there's energy infrastructure opportunities. You can go down the risk threshold and buy into more production with upside scenarios, or you can go more up the risk curve, but diversify across a number of new wells. There's a number of ways to approach that. And a good operator like Jay here will, have a number of ideas that could range from more traditional private equity to drill cos or things of that nature based on my limited understanding of their operation. We continue to look at anything that is just kind of risk adjusted from our standpoint. The stage of the generational wealth management that this family office has really doesn't give us a lot of room for significant risk, and we don't really need to, right? We're really more of a harvesting of traditional returns and not in a win or lose scenario. Well, that said, we still do many direct investments that do carry a substantial amount of risk, but there's ways for us to manage that. Hedging production is one good way, obviously using low leverage, but a variety of creative structures like earnouts or other things, or back-end payouts or other things like that can be a great way to partner with the industry and help you manage your risks while being able to get that higher direct investment return. That said, direct investing isn't for a lot of people, right? Because you've got to be able to finesse that initial relationship with the right operator, who's not always going to be perfect either. And then you've also got to be able to manage that during and after that from that standpoint. So, not to go too far down that particular rabbit hole, but on the other side, we really love anything infrastructure related right now, energy, energy transition, broad civil infrastructure. Those are areas that we feel are some of the hottest new market areas, particularly with digitalization occurring across each of those segments. So we are looking at a number of those particular opportunities. But I think for us, it's more about, a risk-adjusted approach. Can we do tech-enabled private equity? Absolutely. Are we going to do venture capital? Most likely not, unless it's applicable to our portfolio. And so on. But there are a lot of creative and unique ways to go about that. I'd say the co-investment is usually the best approach. There's risk carried by both sides, and you usually bring a unique skill set from both perspectives, and at the very least, additional eyes on that same opportunity. So that's just kind of my high level response. Back to you,
Well,
Arthur.
Thanks, Timothy. I wanted to turn over to Steve and ask him, about your involvement, because you also are playing into the solar and green energy and all the electric vehicles. And if you could tell us a little bit about, what it is that you do in that space, and then what your cool projects are in that area.
Yeah, we're actually not involved in the green energy side at all, Arthur. We're strictly on the
So tell me, what do you
side.
think about it?
Well, what do I think about it? I'm agnostic to it, to be honest with you. It's there. It's something that I believe over time, specifically if you look at electric vehicles, will have a downward pressure on the transportation side of demand for oil. That's not anything drastic in the future. I think electric vehicles have a lot of their own problems, right? You've got, where are you going to source all the cobalt? Where are you going to source all the lithium? I think we just learned through COVID that having too much of a dependence on foreign countries that aren't very friendly to us is not a good idea. And so for electric vehicles, that's definitely a problem. I know there's been some recent permits here in the United States for lithium refining, so our exploration. So we'll see how that goes. So I'm a believer, as an above all strategy for energy for not only the United States but the world. So I don't have a problem with it in any way, shape, or form. I believe on the ESG front, from an operator standpoint, and somebody that invests into the energy space, that is very, very much always been, and ESG has kind of been hijacked, in my personal opinion, by the whole CO2 carbon pitch, right? But being environmentally responsible, being socially responsible, and having good governance policies, that's what ESG stands for. That's what it's always stood for from my perspective. So if you're going to operate, you absolutely need to, operate in a very environmentally responsible way. You need to have all your plans in place in case you have spills. You need to have markets so you don't have to, flare methane, flare your gas. So those are all things that I think are important as an operator. But I think in terms of the overall effect on the demand side of the equation, which is, if I'm looking at energy, if I'm a family office, whether I'm looking at the upstream, midstream, downstream investment side, infrastructure, whatever it may be, the demand side, as you were referencing, is not going away. All projections are for the next 10 years growth in demand. And the reality of it is the supply side has pressures everywhere. So I don't think the United States in specific, I think all of the E&P companies, for the most part, learned their lesson from about 2000. Well, about through 2015, it was basically drill, baby, drill. And in 2014, we had 1,900 rigs in North America. Today, we have about 700. We were down to about 200 during COVID. The slope of the recovery each time has gotten less steep and less steep. I think most of the E&P companies have learned that the financial disciplines are what matters. So just drilling to drill makes absolutely no sense. That's not going to change. So that's going to keep pressure down. If you look at Devon, if you look at Pioneer, if you look at Oxy, they all came out with forecasting for 2023. They've all projected higher capex, but flat to very marginal increases in supply, so in production. So what does that tell you? Either inflation is hitting them because costs are higher, which is partially true. The other side of it, for U.S. side of the equation, is we are in the shale business, right? And that is different than the conventional reservoirs. Permian, or the Pioneer, who is touted as having the best inventory of 15 to 20 years worth of Permian product, by their own documents, if you look at their documents, 50% of that supply is tier 3 drilling locations. So if you're looking to the future for oil and gas investment, specifically my belief on the oil side, as you said as well, I think the commodity side has much more. Obviously, when you're in this space, the really low prices could be tough to sustain. I just don't see a lot of things that would put us down and sustain lower prices going forward. So I think from an investment thesis for the family offices, for individuals, there's a lot of things to be attractive, as long as you have the right risk profile and understand what you're getting into.
if it's okay, I'd like to just kind of segue off your points here, talking about ESG and carbon and everything and emissions. So let's just look at the U.S. real quick. Under the prior administration, we withdrew from the Paris Climate Accords, and under the current administration, we rejoined. But when we rejoined with lower emissions and we withdrew. And that's because in 2007, and so really what I'm saying is, it's because the shale revolution that happened here in the U.S. led to organic coal to gas switching here. And over the past 15 years, we've had 30% economic growth in our country, and we've reduced emissions. Emissions today in the U.S. now are the lowest level in nearly 40 years. And this is driven by our switch from coal to gas, and of course, increasing renewables in our content. So much content of power generation. So today in the U.S., the power sector is no longer the leading cause of emissions. It's transportation. But for the rest of the world, it's still the power sector. So actually, if we're really concerned about fighting emissions globally, the easiest, lowest hanging fruit is natural gas abroad and basically adopting the American model, where you have climate security and economic security. We have lower emissions today. We had cheap natural gas. We have for the past decade. We had a blip last year because of the spikes in LNG and everything. But even now, Henry Hub is back down to manageable levels. So I think that it's a combination of natural gas, renewables globally, reduce emissions. And as much as I agree with you in terms of EVs, look, EV penetration was under 5% a couple years ago. Maybe it's going to be like 7-8% now. The idea that if I build it, they will come, that we're going to have 50% market penetration of EVs in 10 years, I think is absurd. And I mean, maybe people are going to be buying it, but there's not the kind of infrastructure. There's plenty of it there on recharging, but I think there's still a lot of questions around that. I'm not knocking it. I'm just saying, like, be realistic on demand, and demand's not going away. Yes, Marty. Marty's talking about used EVs coming on, the lot in San Francisco. So yeah, probably so. That's another way to recycling EVs. So hopefully, but anyway, I just wanted to mention that in terms of emissions, like we have to be pragmatic, realistic over what we have.
We're just about to wrap up the panel, so I'm just going to kind of go around and then start with Timothy for each one of them. We have like 4 minutes of the panel, so I'll let you guys wrap up with the thoughts of the future of what it is you think, whatever it is that you wanted to say to wrap it up. So Timothy, you're the first, Jay second, and then we'll go to Steve and David.
Sounds great, guys. Well, first off, thanks again for having me here. And I really appreciate hearing the comments from some of my friends and some new people as well. There's always good to be able to trade perspectives and so on. From an oil and gas standpoint, we're long term. I think my sentiments would echo everyone else's in terms of current prices are at or near lows, probably on a longer term basis, but expect lots of cycles. We'll manage those cycles by hedging out production, but there are a lot of opportunities. I don't see any major disruptions to transportation or other consumptions of oil products, or unfortunately any major technology disruptions in renewable energies as a whole. But there are opportunities throughout each of those segments. So that's the way we're viewing it. And for those in Austin and online, we're always happy to network and kick around ideas. I can usually let you know pretty quickly if we think it's in our wheelhouse. So looking forward to it. Marty, again, thanks for having me.
Thank you. Jay?
Thanks. Timothy, well said. I appreciate that. And I'll tell you what, I mean, so fourth generation oil and gas guy. I've been around this business for a long time, and I love the business. I know that Tesla's moving in, and they sold 1.2 million Teslas in California last year. They look to sell 1.8. I mean, hey, you know what? That side of the business is coming. But like Timothy mentioned, there's a lot of other uses that oil has other than just gasoline for cars. So it is very important for our makeup. It's very important. I mean, what did George Bush say in the 2006 State of the Union address? We have not only an appetite for oil, but we have an addiction. We have an addiction to 20 million barrels a day, and we're not producing anywhere close to that. So we're going to need oil for a long time. And our company, we're just looking for assets. And as I mentioned in the post, hey, we're looking to divest our asset every year, because you never know what oil and gas prices are going to do. So, I've alternative investments is our key of what we do. And I don't feel like there's any time that you don't know what the price is going to be next year, even though that, hey, rigs and governments, and you never know what it's going to be. But I feel like that if we can set these things up to sell every year, and if somebody comes along and wants us to take advantage of us, hey, we're open to that. So I appreciate everybody. And Marty, thanks for having me on. Arthur, thanks for being the panelist and putting yourself out there. So thanks everybody.
See you.
Hey, buy my book, and I donate all the money to military. So buy my book, The Upside of Oil and Gas Investing. Come on our website, kingoperating.com. That's it for Jay Young promoting himself today. So appreciate everybody.
One question, guys. One question in the audience.
I think there's a question, or there was a.
Yeah, we
There's an
don't
audience
hear.
question.
Like, Marty, we don't hear you. Like you talking there, and then
There's a question in the audience is coming.
Oh.
microphone not working.
I guess somebody's talking, or
Yeah,
somebody's asking a question.
yeah.
Hold on 1 second.
Okay, all right, sorry.
The question was basically, do we see the public companies beginning to look to make some acquisitions of the private companies and going into 2023 and on? And I would say, my shot on that would be is, I think that I think 2023 is we'll see an increase in M&A activity for sure, because there's been a lot of healthy cash flow, obviously from where commodity prices were last year and where they've been sustaining. So I think you will have an increase in M&A for that reason. The only downside to M&A, in my personal opinion, is for the bigger players, there has to be scalability to whatever they're acquiring, right? And so there was a large wave of consolidation really from 2016 through 2000 pre-COVID. And then of course COVID hit, and we had hundreds, I don't know how many bankruptcies we had after COVID, but it was well over 100. And so there was another wave of consolidation. So but I think you'll see some M&A activity pick up in 2023. Anybody else want to take a shot at that?
I'll just regurgitate some stuff I heard at NAPE earlier this year. From 2010 to today, there's been a 75% reduction in operating in wells being drilled by operators. So it's massive, consolidation in the space. And overall, I think there's more M&A activity to come. So that's what they think. The last thing I'll say, just on behalf of the industry overall, everybody needs to remember, the EPA only has oversight over U.S. produced oil and gas, which means when the administration goes to the Saudis and the Venezuelans, it's actually an end around over EPA oversight. So American oil and gas is the cleanest, most reliable out there, and people need to tell their congressmen. I mean, it's absurd. So